Bloomberg News.
Bloomberg Radio's Tom Keene is speaking with Michael Price, president and founder of MFP Investors. He's giving listeners his recommendations for stock picks in the coming months. Let's get straight to Bloomberg's radio studio.
Michael, we got to turn to Citigroup, the banking shares. You've had your own stress test in value investing. How is Citigroup, and can they survive?
Well, look, Citigroup's going to survive. The government's going to walk it through this period. You are right at the beginning of a 1-month period where they're exchanging, as everyone knows, common for preferred. But it's unique. It's the largest exchange offer I can ever remember. I'm sure it's probably the largest ever. $70 billion of new capital comes on to that balance sheet from the preferred giving up their senior rights to become common, A. And B, don't forget there's a loss sharing. The company takes the first $40 billion of losses, and after that, they only take 10% of the losses on a $180 billion loan book.
And straw hats in winter, and with your experience with chief executive officers, Mr. Pandit is perceived as a quant, but is he the right guy here right now?
No. Look, that's just, he'll drift off. There are probably, and I don't know because I'm not inside, units within Citicorp that are very well run. There are units in Citicorp that are going to be sold and joint ventured. Proceeds will come in, and basically you've got a $4.50 pro forma this exchange offer. You've got a stock at around $3.50 with a $4.50 book. I'm assuming that book drops from $4.50 to $3.75.
Yeah.
The common drifts down from $3.50 during the exchange offer to $3, and around $3. It's probably not going to be a bad shot. You got $40 billion of tax credits. That's 50 cents a share. You've got real estate assets. You've got $7 or $8 billion coming in cash from Morgan Stanley and the Smith Barney joint venture. Everywhere you look, you're going to find another 10 or 20 cents a share. And in a $3 stock, it doesn't take much.
So Citi survives, but not in its present form, which is another way of asking, is the Sanford Weill business model completely discredited now?
Totally.
I mean, it didn't work with Sears Roebuck and Dean Witter, and it's not going to work anymore.
No, it's too big. You can't run effectively huge conglomerates in financials.
When you see an essay or an op-ed piece by Henry Kaufman, and he talks about this fear of concentration of banks, if we assume fewer banks out there, and if we assume we get through this and life goes on, how does Michael Price define a utility bank? What will be the new financial services?
Very focused, starting community and regional bank where they know their customers, they really watch over their balance sheets carefully, and are much more well capitalized. So less leverage. Less leverage,
more capitalized. Where will the entrepreneurial financial innovation come? Does it come out to a new shadow banking system?
The banks are allowed to run at 12 or 15 times leverage. You don't have to get too creative when you can lever up, your equity 12 times safely.
I want to change gears. Ken, you got something, Ken?
Yeah, I just wanted to ask, why not just go and buy community banks then?
Yeah,
well,
great idea.
We are long community banks. We're long a little bigger bank than community. We just bought BB&T on their deal last week. They recapped it. I think their deposit franchise is worth a lot.
Well,
I mean, you look at these banks that are making these moves. Wells Fargo's big recap. I mean, Wells Fargo is, you don't have better run banks. I mean, you want to place some bets. You can place them right after the recap like BB&T and Wells Fargo, or you can start nibbling on the way down in Citicorp now, which is very liquid, or, you can put money into smaller, less liquid banks that are not in TARP. TARP, let me just make a point. TARP front-ran value investors. We missed big opportunities because of the TARP program, because the banker would rather take the government's money, even with their strings attached, than my money, diluting the common.
With that, do you shift gears like a Wilbur Ross? Does Michael Price go in quietly and take out a Florida bank?
Well, we looked at IndyMac, we looked at Bank United. We've looked at these, and I want liquidity, and I want to trade in these things.
I want to switch gears if I could.
One more banking question.
One more banking question.
Is this also,
over here.
Michael, a bet that dividends are going to be restored eventually, sooner or later?
Yeah, in a while.
Yeah.
I mean, they should not be paying dividends. Okay, and just think about this exchange offer. There's no Citicorp dividend, right? But all these preferreds, and some of them were just sold in January of 2008, are being forced into a non-dividend paying common. One of the big preferred issues, the $3 billion, the AA issue, with an 8.125% coupon sold in January of 2008 at $25 a share, is being forced into common today.
Real quickly here before TV leaves us here, this idea here of a dividend, the value of a dividend. We were talking industrial companies earlier. Where's your best quality dividend stream right now?
Okay. I think you got to be real careful with dividends. If the company has a clean as a whistle balance sheet, their dividends make it through. But companies in this environment need to bring dividends down. I like it when they don't pay a dividend because that's going to deliver a stock price to me that doesn't have the yield in it, so it's going to be cheaper. This time around, they went to Washington where, they opened their wallet. They brought capital in the level of preferred, senior to common, got warrants, as we all know the story, with a coupon, and we were shut out of the process.
You were shut out of the process. For our viewers and listeners here, folks, we're talking about TARP and how some of the substantial investors in the nation, indeed the world, were shut out of the process. When you say shut out of the process, what's the so what there? Why do we care that Michael Price was pushed aside by Tim Geithner?
Well, in some cases, the capital needs were so great, the Citicorps of the world,
right,
that you needed the government. But in most of the cases, 85% of the cases, those banks could have gone to the private markets in the last 6 months.
We've been talking about stocks so far, Michael, but your mentor in the business, Max, I've never been sure
Max
how to pronounce Heine, made a name for himself by wading into the market for railroad bonds back in the 60s when they were all going bankrupt and then settling up later in bankruptcy court for a multiple of what he paid. Similar opportunities today?
Look, Penn Central filed.
Okay, that is Michael Price speaking with Tom Keene and Ken Pruitt in Bloomberg Radio's studio.
Hear more Bloomberg News reports on the Bloomberg Terminal at AV Go, on Bloomberg Television, and on Bloomberg Radio. Copyright Bloomberg LP 2009.